Hello and welcome everybody to another episode of Books and Bytes today, where we're going to crack open a real classic in economic theory, a book that's still sparking debate over a century after it was written. We're talking about The Theory of Money and Credit by Ludwig von Mises.
Yeah, it's amazing how relevant this book remains. Even though it was published way back in 1912, Mises was really grappling with some fundamental questions about money and banking at a time when the world was on the cusp of some really major economic shifts. And I think his insights into the nature of money, its value, and the role of banking, they've really stood the test of time.
For sure. For our listeners who might not be familiar with him, could you give us a quick snapshot? Like, who was Ludwig von Mises and why is his work so important?
Absolutely. So Ludwig von Mises was a leading figure in what's known as the Austrian School of economics. And this school of thought, they really emphasize individual choice, free markets, and the limitations of government intervention. So Mises, he was a staunch defender of sound money principles and a really strong critic of inflationary policies.
Okay, so that sets the stage for us. So in The Theory of Money and Credit, Mises dives deep into, well, money and credit. But before we get into the nitty-gritty, can you give us a quick overview of the main themes that he explores in this book?
Sure. So Mises, he starts by laying the groundwork for understanding the nature of money itself. He challenges the idea that money is simply a creation of the state. He argues that money emerges organically from the actions and choices of individuals in a market economy.
So it's not just something that a king or a government decrees. It comes from the bottom up,
Yeah.
from people deciding what they will use to trade with each other. That's a pretty radical idea for its time.
Right. It was. And it still challenges, I think, conventional thinking about money.
Yeah.
And then from there, Mises goes on to explore the subjective and objective aspects of money's value. He challenges traditional quantity theory, which basically says that the value of money is solely determined by how much of it is in circulation.
So is he saying that printing more money doesn't automatically make a country wealthier?
Exactly. Mises argues that the demand for money plays a critical role in determining its value. Just increasing the money supply without a corresponding increase in demand, well, that can lead to inflation, which erodes the purchasing power of money. So he really drives home the point that there's a difference between having more money and having money that's worth something.
That makes a lot of sense. So if it's not just about the quantity of money, what else determines its value?
That's a great question, and Mises dives into that too. He looks at the role of subjective valuations, what people think money is worth, as well as the objective factors like the availability of goods and services in the economy.
It sounds like he's painting a much more complex picture of money than just looking at how many dollar bills are floating around.
Absolutely. And then from there, he shifts focus to the role of banks in the monetary system. And this is where things get really interesting. He argues that banks, through their lending practices, actually create new money, what he calls fiduciary media, which is essentially credit that's circulating in the economy alongside actual money.
Okay, I can see how this could be a good thing, because more credit could mean more investment in economic growth, but I bet there's a potential downside here too.
All right, you're sharp. Mises was very aware of the potential dangers of credit expansion. He argued that if this process isn't managed carefully, it can lead to economic booms and busts, those cycles of euphoria and despair that we see throughout history.
Think of the housing bubble in the mid-2000s,
Huh?
or the dot-com bubble in the late 1990s. Were those fueled by the type of credit expansion that Mises was warning about?
Exactly. So he was writing in a time when gold was still a major part of monetary systems, but he was already anticipating many of the challenges we face today, with fiat currencies and the expansion of credit.
So what does Mises propose as a solution to these potential problems?
Well, in the final part of the book, he lays out principles for what he calls monetary reconstruction, a framework for a sound and stable monetary system. And you guessed it, he was a big fan of the gold standard.
So backing money with something tangible, like gold, would theoretically prevent governments from just printing money whenever they felt like it.
Precisely. Mises saw gold as a way to discipline governments and prevent them from engaging in excessive money printing, which he believed was a root cause of inflation and economic instability. But his ideas go beyond just advocating for a gold standard. He makes a broader case for individual economic freedom, limited government intervention, and a deep understanding of the principles that underlie a healthy monetary system.
Wow. That's quite a journey through some pretty complex economic ideas. And it's incredible how much of what he was writing about over a century ago still feels so relevant today.
It really is. And I think one of the most fascinating things about Mises is how he connects these abstract economic theories to the real-world experiences of individuals. He shows how the choices we make about money and credit can have profound effects on our lives and the well-being of society as a whole.
He makes a powerful point about the importance of understanding how money works. It's not just about numbers and equations. It's about people, choices,
Hmm.
and consequences.
Exactly. And that's what makes the theory of money and credit such an enduring and influential work. It challenges us to think critically about the role of money in our lives and to consider the long-term implications of our monetary choices.
Okay, so we've got a sense of the big picture now. We know that Mises argues that money originates from individuals, that value is tied to both objective and subjective factors. Banks play a powerful role in creating credit, and the gold standard could offer a path to a more stable monetary system. But let's unpack these ideas in more detail, starting with Mises' challenge to the conventional view of where money comes from.
That's a great place to start. This is where Mises really lays the foundation for his entire theory of money and credit. He asks us to consider a scenario where there's no government, no central bank, just individuals interacting in a market.
So like a barter system, where people are trading goods and services directly with each other.
Exactly. But imagine how clunky and inefficient that would be. You would have to find someone who has what you want and wants what you have. It would be a constant search for the perfect match. And that's where money enters the picture.
It becomes a way to make those transactions smoother and more efficient. Instead of having to trade a chicken for a pair of shoes, I can use money to buy both.
You got it. But Mises' point is that this evolution of money, it doesn't require a government decree. It emerges naturally from the actions of individuals.
So how does that work? How does something become money if no one is forcing people to use it?
That's where Mises introduces the concept of marketability. He argues that certain goods, over time, become more widely accepted as mediums of exchange because they're more marketable. They're easier to trade for other goods.
So it's like a popularity contest for goods. The most widely accepted and easily traded goods eventually become money.
That's a good way to think about it. These goods, they might have some inherent value, like gold, which has been used as money for centuries. Or they might derive their value solely from their usefulness as a medium of exchange.
I can see how that would happen if everyone is using something to trade. Even if it doesn't have a lot of inherent value, it becomes valuable simply because it's widely accepted. But doesn't this contradict the idea that money needs to be backed by something tangible like gold?
That's a great question, and it gets to the heart of one of the biggest debates in monetary theory, the debate between commodity money and fiat money. Mises himself was a strong advocate for commodity money, particularly gold. But he also recognized that money could function, even if it wasn't directly tied to a physical commodity, as long as it was widely accepted and trusted.
So even though Mises preferred a gold standard, he acknowledged that money could emerge and function in different ways.
He did. And this leads us to one of Mises' most important insights, the distinction between money and money substitutes.
Okay, what are money substitutes?
So think of things like credit, checks, even IOUs, anything that can be used in place of actual money to facilitate transactions.
So they're not money itself, but they can act like money.
Exactly. They expand the money supply beyond just physical currency. And while this can have benefits, Mises warns that money substitutes can also introduce instability into the system if they're not carefully managed.
So this is where we start to see the potential for those booms and busts that we talked about earlier.
You got it. But let's not get ahead of ourselves. There's a lot more to explore in Mises' theory of money and credit. And I think it's worth diving deeper into this distinction between money and money substitutes. It's a concept that's crucial for understanding how our modern financial system works. And it's something that Mises was writing about long before it became a mainstream topic.
Okay, so let's dive in. Why is this distinction so important? And how does it help us understand the complexities of money and credit?
Well, one of the key things Mises points out is that while money substitutes can behave similarly to money in the short term, they have different implications for things like inflation and economic stability in the long run.
So using more credit might feel like having more money in the moment, but it could have negative consequences down the road.
Exactly. That's because money substitutes, unlike actual money, are often based on promises to pay in the future. They represent claims on real goods and services that may or may not materialize.
So if everyone suddenly wants to cash in their IOUs, there might not be enough actual goods to go around. That sounds like a recipe for trouble.
It can be, and this is one of the reasons why Mises was so cautious. about the expansion of credit and the role of banks in creating money substitutes. He believed that excessive credit creation could distort market signals, lead to malinvestment, and ultimately contribute to economic instability.
That makes sense. But didn't he also acknowledge that banks could play a positive role in the economy?
He did. He recognized that banks, by channeling savings into productive investments, could facilitate economic growth. But he was also very concerned about the potential for abuse, the dangers of excessive credit creation that wasn't backed by real
So
savings.
it's all about finding that balance
Mm,
between the benefits of credit and the risks of excessive expansion.
exactly. And that's where Mises' insights into the nature of money, its value, and the role of banking become so important. They provide a framework for understanding the complexities of the monetary system and for making sound policy decisions that promote economic stability and prosperity.
Okay. We've covered a lot of ground already. We've delved into Mises' ideas about the origins of money, the distinction between money and money substitutes, and the potential dangers of excessive credit creation. In the next part, I'm really eager to dig deeper into his views on the value of money and how it's influenced by both objective and subjective factors. That sounds fascinating.
It is fascinating, and it's a crucial part of understanding his overall theory of money and credit. He offers some truly insightful perspectives on how we perceive value, how it fluctuates, and the impact that those fluctuations can have on our lives.
Well, I can't wait to unpack those ideas with you for our listeners. Join us for the next part of our deep dive into the theory of money and credit, where we'll explore the subjective and objective forces that shape the value of money and the implications for our economic well-being.
So, picking up where we left off, let's explore how Mises tackles one of the most fundamental questions in economics. What gives money its value?
Yeah, it seems pretty straightforward at first glance, right? Money is valuable because we can use it to buy things, but I have a feeling Mises digs a lot deeper than that.
He absolutely does. He argues that the value of money, like the value of any good or service, isn't inherent. It's determined by a complex interplay of objective and subjective factors.
Okay, I'm intrigued. What does he mean by objective and subjective factors in this context?
So on the objective side, you have things like the scarcity of money, like how much of it is in circulation, and the quantity of goods and services available in the economy. These are measurable, quantifiable factors that can influence money's purchasing power.
So if there's a lot of money circulating but not a lot of goods to buy, the value of each unit of money goes down. Basic supply and demand.
Right, exactly. But Mises goes beyond this simple equation. He emphasizes the crucial role of subjective valuations, the perceptions and preferences of individuals.
So it's not just about how much money exists or how many goods are available. It's also about what people think that money is worth.
Precisely. He argues that individuals constantly make subjective judgments about the value of money, based on their own needs, expectations, and experiences. And these subjective valuations can have a significant impact on the overall value of money in the market.
So if everyone suddenly loses confidence in a particular currency, its value could plummet, even if there hasn't been a change in the actual supply of money.
That's exactly what can happen. We see this in cases of hyperinflation, where people lose faith in a currency so rapidly that its value collapses almost overnight.
That makes the whole idea of money seem a lot more fragile than I realized. It's not just about those bills and coins. It's about a shared belief in their value.
That's a key takeaway from Mises' work. He challenges the notion that money's value is solely determined by objective factors. It's also deeply intertwined with subjective perceptions and beliefs.
This makes me wonder about something we discussed earlier. Money substitutes. Things like credit and IOUs. Do those also have this subjective element to their value?
They absolutely do. Think about it. A loan, for example, is essentially a promise to pay in the future. The value of that promise, that credit, is heavily influenced by the lender's belief that the borrower will actually repay the debt.
So it's not just about the amount of money being lent. It's about the trust between the lender and the borrower.
Exactly. And if that trust erodes, the value of that credit can plummet, just like the value of a currency can plummet during hyperinflation.
Wow, Mises is really pulling back the curtain on all these assumptions we make about money and credit. It's not as simple as we might think.
Not at all. And this is where his work gets really interesting, because he starts to connect these seemingly abstract ideas about money and value to real-world phenomena like inflation and business cycles.
Okay, I'm eager to hear more about that connection. How does Mises' theory of money's value help us understand things like inflation and economic booms and busts?
Well, one of his key insights is that inflation isn't simply a matter of prices going up, it's a monetary phenomenon, rooted in an increase in the supply of money and credit relative to the demand for them.
So if the government prints too much money, or if banks create too much credit, it can lead to inflation.
That's a big part of it, yes. But remember, it's not just about the quantity of money and credit, it's also about the demand for them. If people lose confidence in a currency, for example, they'll be less likely to hold on to it, which can further fuel inflation.
It's like a vicious cycle. Inflation erodes confidence,
Hmm.
which leads to more inflation. And all of this ties back to those subjective valuations we were talking about earlier.
Right, absolutely. Inflation is not just an objective measure of price increases. It's also a reflection of the subjective perceptions and anxieties of individuals.
Okay, so inflation is about more than just prices going up. It's a complex interplay of objective and subjective factors.
Yeah.
But how does this all tie into those economic booms and busts that Mises was so concerned about?
This is where his theory of the business cycle comes into play. Mises argued that these cycles of boom and bust are often driven by distortions in the monetary system, particularly the artificial lowering of interest rates by central banks.
Wait, back up a second. We haven't really talked about interest rates yet. How do those fit into all of this?
Interest rates play a crucial role in Mises' theory. He saw them as reflecting the time preference of individuals. This is the idea that people generally value present goods more highly than future goods.
Okay, that makes sense. I'd rather have $100 today than $100 a year from now. There's a certain bird in hand element to it.
Exactly. And this preference for present goods is what drives interest rates. People are willing to pay a premium in the form of interest to have access to goods and services now rather than later.
So interest rates aren't just some arbitrary number set by banks. They reflect the fundamental human preference for immediate gratification.
That's a key insight for Mises. And it has profound implications for how we think about monetary policy.
Okay, I'm starting to see the connection here. So what happens when central banks artificially lower interest rates below this natural market rate that reflects people's time preference?
This is where Mises argues that things start to go awry. When interest rates are artificially suppressed, it creates a false signal in the market. It makes credit cheaper and encourages businesses to borrow and invest in projects that wouldn't be profitable at a higher market-determined interest rate.
So it's like building a house on a foundation of sand. It might look good for a while, but eventually the whole thing collapses.
That's a great analogy, and that's essentially what Mises argued happens. When central banks keep interest rates too low for too long, it creates an artificial boom, fueled by malinvestment and unsustainable credit expansion.
And eventually that boom turns into a bust.
Exactly, because those investments that were made based on artificially low interest rates weren't actually sound.
Yeah.
When the central bank eventually has to raise rates to combat inflation or other problems, the bubble bursts and the economy goes into a downturn.
This all sounds very familiar. Haven't we seen this play out in recent decades?
Yeah.
With the housing bubble and the financial crisis?
We certainly have. And Mises' work offers a compelling framework for understanding these cyclical booms and busts. He saw them not as inherent flaws in capitalism, but as consequences of distortions in the monetary system, often driven by central bank policies.
It's amazing how prescient his insights were. He was writing about these things over a century ago, but his ideas still resonate today.
They do. And that's a testament to the enduring power of his analysis. He forces us to look beyond the surface, to understand the underlying causes of economic phenomena, rather than just treating the symptoms.
Okay, so we've covered a lot of ground here. We've talked about the subjective and objective factors that influence the value of money, the role of interest rates, and how distortions in the monetary system can lead to booms and busts. But there's still one piece of the puzzle we haven't explored in detail: Mises' solution to these problems. His vision for monetary reconstruction. I know he was a big proponent of the gold standard.
He was, and we'll dive into that in the next part. But it's important to remember that Mises' ideas go beyond just advocating for a particular monetary system. He makes a broader case for sound money principles, limited government intervention, and a deep understanding of the intricate relationship between money, credit, and economic activity.
I'm really eager to hear more about his proposed solutions and how his ideas might be applied to the challenges we face in the 21st century. For our listeners, be sure to join us for the final part of our deep dive into the theory of money and credit, where we'll explore Mises' vision for a more stable and prosperous monetary system. Okay, so we've journeyed through some pretty dense economic theory with Mises, and now I'm ready for the so what. What did he actually propose we do about all these problems with money and banking?
Yeah, that's where his ideas on monetary reconstruction come in. And as you hinted at, he was a staunch defender of the gold standard.
But hold on, lots of folks see the gold standard as this kind of outdated relic. Why was Mises so keen on it?
Well, I think Mises saw gold as more than just shiny metal. To him, it was a way to discipline governments and limit their ability to meddle with the money supply.
Because with gold, you can't just print more of it on a whim.
Right.
There's a physical limit.
Exactly. That limited supply was key for Mises. He believed that tying a currency to gold would create inherent stability and prevent those inflationary spirals that we discussed earlier. Remember, he lived through a period when many European countries were abandoning the gold standard, and he saw it as a dangerous move towards unchecked government control of money.
So for Mises, gold was like a safeguard against those booms and busts driven by artificial credit expansion.
Precisely. He argued that under a gold standard, banks would be more cautious about lending because they couldn't just create credit out of thin air. They would have to ensure that their loans were backed by actual gold reserves.
That makes sense. But wouldn't a gold standard also limit economic growth? I mean, if you can't easily expand the money supply, wouldn't that stifle investment and innovation?
That's a common critique, and Mises addressed it head-on. He argued that real sustainable economic growth comes not from manipulating the money supply, but from genuine savings and investment.
So instead of relying on cheap credit fueled by central bank intervention, you need people to actually save their money, which then gets channeled into productive investments.
You got it. Mises believed that this kind of organic growth, driven by real savings, was far more stable and beneficial in the long run than the artificial booms created by credit expansion.
It's like the difference between building a house on a solid foundation versus a shaky one.
Perfect analogy. Now, whether a gold standard is the best or only way to achieve this kind of monetary stability is a complex debate, and one we could have an entirely separate deep dive on.
I'd be up for that. But for now, let's stick with Mises. So gold was a big part of his vision for monetary reform. What else did he propose?
Well beyond the technical aspects of a monetary system, Mises emphasized the importance of certain principles. And those are arguably even more relevant today than his specific policy prescriptions.
What kind of principles are we talking about?
First and foremost, he was a champion of individual economic freedom. He believed that individuals should be free to choose how they use and manage their money without undue interference from the government.
So less regulation, more autonomy for individuals in the financial realm.
Exactly. He saw this freedom as essential for a healthy and dynamic economy. He also stressed the importance of sound banking practices. Remember, Mises wasn't anti-bank, but he was deeply skeptical of fractional reserve banking, where banks lend out far more money than they hold in reserve.
He saw that as a recipe for trouble, right? Too much potential for creating credit bubbles and fueling instability.
Precisely. He advocated for a system where banks would be more closely tied to real savings and would exercise greater prudence in their lending practices.
This all ties back to his core belief in the free market, doesn't it?
Yeah.
He saw the government's attempts to manipulate the money supply and credit markets as ultimately distorting those markets and creating more problems than they solve.
You're absolutely right. And he made a powerful case for why understanding these principles of sound money and limited government intervention is essential not just for economists, but for everyone.
Because ultimately, it affects all of us, right? The way our monetary system is managed has a direct impact on our lives, our savings, our ability to plan for the future.
Precisely. And that's why Mises' work continues to resonate today. Even if you don't agree with all of his conclusions, he challenges us to think deeply about the role of money in society and to be wary of the unintended consequences of well-intentioned, but ultimately misguided policies.
He's a reminder that economics isn't just about numbers and graphs. It's about real people making choices with real consequences.
Exactly. And the theory of money and credit provides a framework for understanding those choices and their impact on our lives.
This has been a fascinating deep dive. We've covered a lot of ground, from the origins of money to the dangers of credit expansion to Mises' vision for monetary reform. What would you say are the most important takeaways for our listeners?
I'd say there are 3 key insights to remember. First, money is not simply a creation of the state. It emerges from the actions and choices of individuals. Second, the value of money is not solely determined by objective factors. Subjective perceptions and expectations play a crucial role. And third, understanding the principles of sound money and the potential dangers of excessive credit creation is essential for promoting economic stability and prosperity.
Those are powerful ideas, and they're just as relevant today as they were when Mises first wrote about them over a century ago. Thank you for taking us on this deep dive. For our listeners, if you're intrigued by what you've heard, I highly encourage you to check out The Theory of Money and Credit for yourself. It's a challenging but rewarding read, and it's sure to give you a deeper understanding of this complex world of money and banking. Until next time, on Books and Bytes, keep those pages turning.